Today we're going to talk about how you can get started creating your own private family bank that you can use to build generational wealth for you and your family. You're only as free as your purchasing power permits, and we are on a mission to get as many people as possible free. So if you're ready to get started on that journey, check the video description and book a meeting with us. If you're not, drop a like, subscribe, share this content. We want to reach more people and get them started on their journey. Life insurance is the best foundation for a family bank, and we're going to get into some of those details as to why that is the case and why it's the best. We're not going to talk about some of the problems with some of the other things that you can use to do things that are similar, but drop a comment below if you want to know about some of the reasons why other vehicles are not as good. Starting with whole life, it's probably the most common when people are talking about the infinite banking concept. They're talking about whole life, and that's primarily because it has the highest guaranteed cash value growth. So when you hear about infinite banking, bank on yourself, cashflow banking, or all these terms where you use an insurance policy as your private bank, they all talk about the concept of a mutual company. And really that's where you want to go. If you're going to get a whole life policy to use as your private line of credit, you want to use a mutual company. Your policyholders are owners of the company. You're not splitting the earnings of the company with shareholders. So if you're going to get a whole life policy, you should probably do it through a mutual company. And cash value growth is based on your dividend rates. So at the start of 2022, there was a change in the rules. Previously, insurance companies were required to give 4% growth in their policies as a guarantee. And now the guarantees are between 2 and 4%. And it's not exactly a bad thing. I'm not going to get into details as to what that's about in this video, but know that you should have a guarantee of around 2 to 4% growth in your insurance policy in whole life. Carriers also declare a gross dividend. That's the total dividend each year. That's not the amount that gets credited to your account. So the life insurance company declares a gross dividend rate that applies to all of the whole life policies with the mutual company. Then the expenses get subtracted out, like administrative fees and other types of fees like riders that you might have, like a term rider and things like that. And then your guaranteed growth is a subset of that. So that part is sort of subtracted from that gross dividend rate. And if the company struggles that year, they still have to credit you that guaranteed rate. And the surplus dividend is the difference between the guaranteed rate and the gross dividend. And so that's how you're credited with that surplus dividend. How does a whole life company earn money for both you and them? This picture is of a whole life company, Penn Mutual. I have a whole life policy with Penn Mutual, and it is their investment portfolio. And as you can see here, the majority of what they are invested in is cash, short-term bonds, and investment grade bonds. Then you can see 1.4% is in common and preferred stocks, so a very small subset. 10.4% other invested assets. And then you can see 6.7% in venture capital, private equity, and other alternative investments. And then 3.5% in below grade bonds, and 0.1% in mortgages and real estate. So they're very heavy and extremely secure, safe returns. That is what life insurance companies do, because their primary purpose is to pay out death benefit to their the beneficiaries of their policyholders. With cash value life insurance, you have contractual guaranteed access to your cash value through policy loans. And that's really powerful for people like myself who are real estate investors. If I have $300,000 of cash value in my policy, I don't have to go through any underwriting or any approvals. I can have those funds cleared in my account within a matter of days if I want to cash purchase a property. And this is not reported to any kind of credit bureau. When you take a policy loan from the insurance carrier, they put a lien against your death benefit, and that's how they're able to offer very competitive rates. And that interest you're paying to the carrier is set by them. Some have fixed and some have variable loan terms. And you continue to earn dividends based on those funds that you have loaned out. So you could be purchasing a piece of real estate, but still earning funds on those, earning interest on those funds. With a whole life insurance policy, you can get an insurance-backed line of credit from a bank or IBLOC, and that will collateralize your cash value, and you can have lower interest rates as a product of this, and gives you some opportunity for arbitrage between how much money you're earning on the funds within the policy and how much interest you're paying when you use those loans or that line of credit from the bank who issues this. Now, this will report to the credit bureaus if you do this option, but it is a good option for whole life. Permanent life insurance, like whole life or universal life, will have the concept of living benefit riders. Different carriers will have combinations of these, but chronic illness, terminal illness, and critical illness are some of the riders that would allow for you to access, in some cases, up to the full death benefit while you're living if you have a medical diagnosis for one of these things. And different carriers will have different rules for how to use these riders. When we talk about overfunded whole life insurance, we're referring to the paid up additional insurance, or PUA rider. That means you're buying permanent units of life insurance. So in my case, when I put $50,000 of PUAs into my permanent life insurance product, I have somewhere around $150,000 or $160,000 of life insurance being purchased permanently in my policy. So after a few years of funding a whole life policy, you can do what's called reduce paid up, or RPU. You reduce the base policy to only what's already been paid up, and in addition to that, you're paid up additional insurance that you've already purchased, and you don't have to pay any more premiums for the rest of your life. You'll have a death benefit, and your cash value continues to grow based on the dividends that are paid out from the insurance company. In the 1970s, there was a lot of people who kind of caught on to being able to use life insurance as a tax shelter. And so in the 1980s, the IRS and the government came out with the rules to establish this concept of a modified endowment contract, which basically sets limits on how much money you can put into a life insurance policy based on your death benefit. So we want to avoid a modified endowment contract because then the earnings inside of that policy can be taxed. And we don't want that because we want tax-free, income tax-free access to our funds within our life insurance policy. In order to maximize the efficiency of a whole life policy, we use a term rider to increase the death benefit and prevent a modified endowment contract, but still allow for us to stuff in a whole lot of cash into that whole life policy so we can get massive amounts of growth. You can expect a 4 to 6% internal rate of return over the life of the policy. And this is really good considering that we can access these funds income tax-free, and it passes to our beneficiaries through the death benefit income tax-free. One of the ways that we can access the funds income tax-free is by withdrawing up to our basis. The amount of premium that we've paid into the policy, we can withdraw those funds income tax-free. We can also access the funds income tax-free through policy loans. If you're looking to use this as a retirement income stream, you might, at retirement age, withdraw up to your basis for an income stream, and then once you've hit that point, you start taking policy loans throughout your retirement to continue accessing those funds tax-free. And then all of that, the loans will just get subtracted from your death benefit. The death benefit pays out income tax-free to your beneficiaries, and this is exactly how the wealthy build and maintain generational wealth. First, you open a policy on your primary earner if age and health rating are good enough to make it an efficient policy. Then you open it up on your spouse and on your children and your grandchildren. The death benefit, since these are permanent insurance policies that contractually will pay out, and we're funding them at levels where there's a guarantee that they will have a death benefit when you pass away, then it passes income tax-free to your beneficiaries. Since we started those policies on the children and grandchildren early, they're going to have even more time for the compound interest to kick in, and the numbers become pretty insane. Even the small funding levels can be tens of millions of dollars as they reach retirement age. Since we're using permanent insurance, and we're funding at a level that pretty much guarantees that we're going to have a death benefit when we pass away, then subsequent generations' insurance policies are funded by the death benefit paid out by the previous generations. And this all becomes a family bank. You can put structures in place in order to establish how people access the funds from anywhere in the family, and it really acts like a bank, and it is your private bank. And this will be able to fund college, business ventures, philanthropy, lifestyle, real estate investments, really whatever you want to do. And this is how the billionaires continue to grow and maintain wealth. If you want to know more, check out this video on turning $33 a day into millions of net worth. Or if you want to see a full video walkthrough of one of my insurance policies, check out this video.